Mr. Knight, please proceed.
Thank you, Mr. Chairman, and thank you for the opportunity to testify today before this distinguished committee. Ranking Member Shelby, it's a pleasure to be back here. I have to tell you, this subject is a subject that is a very passionate topic at NASDAQ right now. And this hearing comes at a very critical moment in our economic history. We have a jobs crisis in this country, and we need to do something about it. We don't have a lot of money to spend to deal with this crisis, and we think one way to get dramatic action in this area is through showing some attention to the public equity markets. The legislation you have before you today is very important. It deals with the private markets. The private markets work hand in glove with the public equity markets. We want them to be strong. We want them to have the most modern regulation and up-to-date regulation. And we think there's a lot of merit to the legislation you're considering. But as we make it easier for companies to choose the private company route and avoid public capital markets, either by staying private or by going overseas to list, we should also deal with structural issues that make the U.S. public markets less attractive than they could be. We know it's not your intention, but we think if the committee acted only on these bills, it could be interpreted as a sign of retreat from the public markets. We strongly urge the committee to expand the scope of this action and look at reforms of the public markets. Now, some might ask, if you can access the capital you need from the private markets, what is the concern? I'll give you 3 reasons. 1, jobs. A healthy public equity market enables companies to raise capital more efficiently, funding more rapid growth and more jobs. Companies create 90% of their new jobs after they go public. Companies create 90% of their new jobs after they go public. Second, efficient pricing. A public company trading on a public market provides the most efficient pricing and funding of entrepreneurial activity. It is well recognized that companies that do not trade on transparent exchanges or exchange-like venues are valued at a discount. Third, public access. A public listing allows access to ownership by the most diverse universe of investors. At NASDAQ, we believe that equity ownership and participation as shareholders in entrepreneurial-led growth should be widely available to the public. We may be biased, but we believe an initial public offering is the best policy outcome in terms of jobs. But I want to be careful here. I don't want to look like I'm talking our own book. So let's look at the facts. From 1995 to 2010, listings on U.S. exchanges shrank from 8,000 to 5,000 companies, while listings on non-U.S. exchanges around the world grew from 23,000 to 40,000. The U.S. averaged 398 IPOs per year in the 1990s, while in the last 10 years, it's only been 117. Today, IPOs are much larger in size because, as we're told over and over again, the increased regulatory costs associated with the public company model. I'm not suggesting that the health of the U.S. economy is directly tied to the number of IPOs on NASDAQ or the number of listings on U.S. exchanges, but I do know, and my testimony spells out in more detail, when IPO capital formation is restricted, entrepreneurs are incented more often to create products that complement the existing products of large companies rather than creating transformational products. Moreover, entrepreneurs may be tempted to sell their ideas too cheaply in the private markets. In the broadest terms, we believe resources are inefficiently allocated when public capital formation is unnecessarily constrained. How do we improve these markets? 2 areas: the regulation of the markets themselves and the regulation of the companies. We embrace some recent studies. I point to the President's Council on Jobs and Competitiveness and the IPO Task Force, which Scott mentioned earlier. There are 4 ideas that come out of that. Our goal should be to restore the ecosystem that used to exist to support these companies. When I talk to my colleagues and what is the difference today than in the 1990s, they say that ecosystem no longer exists. How do we get that ecosystem started again? One issue that comes up over and over again, and to a person, when I ask people, why do people say they don't want to list publicly? Why do they list outside of the United States? The issue that comes up over and over and over again is 404. 404 needs to be reformed in Sarbanes-Oxley. PCAOB retains broad powers in this area. They can act to police the accounting industry without imposing this burden on public companies. The President's Counsel recommended a $1 billion ALPA for companies from 404 that are valued at $1 billion or below. We endorse that. Second, we believe we need to adopt the ramp on idea that, again, Scott mentioned, that's in the IPO task force recommendations that were delivered to Treasury, that I believe is embraced in Senator Toomey's and Schumer's bill in dealing with regulation in this area and scale up regulation for smaller companies. This scaling of disclosure and administratively burdensome regulations, we think, will help jumpstart this area. Third, a venture capital market. We think we need special rules for a venture capital market in the United States. Vancouver has 2,100 companies on their venture market. We run a venture market in Sweden that's very successful, but we need the SEC's help to create some trading rules in that area. And fourth, the SEC has had before it for over a year, 2 years, in fact, a market structure reform set of recommendations embodied in a concept release. We think that we're overdue to act upon that and revise the market structure in the public markets to reduce fragmentation and darkness. Let me close by saying NASDAQ is not opposed to regulation. We are one of the most heavily regulated businesses in the world. This year, we will make 400 rule filings with the SEC just to keep our business going. We believe in this regulation. It has served the public well. But if you study the public company model and the empirical evidence from the last 10 years, you will clearly find that in some areas we have gone too far and in other areas we have been neglectful. This is not a partisan issue. There's no need to assign blame. We all want more and better jobs in the United States. The public equity markets have been the best source of jobs in this economy and in this country, and attention should be paid to those markets.